Say you close on a house in California this month. The state's median price, according to the California Association of Realtors, is $904,640. You put 20% down. Freddie Mac's weekly mortgage survey has the going rate at 6.58%. Your loan comes to $724,000. Principal and interest, the number on your closing disclosure, is $4,614 a month. That is not what the house will cost you to keep. Not close. Tax, insurance, utilities, and basic upkeep land on top of it. Add those up, and you are paying somewhere between $6,885 and $7,639 a month for the same house. The mortgage was never the number. It was the smallest one. By the end of this video, you will understand two things. Why the property tax bill, the line everyone assumes is California's punishment for buying here, is actually the calm, predictable part of owning this house. And what the volatile part, the one nobody prices in at closing, could cost you if you own in the wrong zip code when the wrong year arrives. That $904,640 figure is a statewide blended number, and it hides enormous range. Zillow puts the typical Los Angeles area home at $936,939. In the Bay Area, the California Association of Realtors has the single-family median at $1.45 million, with San Francisco County itself running $2.2 million, up 22.2% in a single year. San Diego County sits at $1,085,000, according to Redfin. The math below assumes the statewide median. In the Bay Area, multiply it. Start with the down payment. It is bigger here than almost anywhere else in the country. Nationally, the typical buyer puts down 19%. A first-time buyer puts down closer to 10%, according to reporting compiled by the Motley Fool. In San Francisco, mortgage data compiled by Sammamish Mortgage puts the typical down payment at 23.3% of the purchase price. In raw dollars, that's a median of $400,310 as of January this year. In San Jose, it's $360,000. In Anaheim, $270,800. California's own Realtor Association estimates that only 18% of the state's households can afford the median-priced home at all. Then there's the cost of the transaction itself. Closing costs on a California purchase run roughly 1 to 2% of the price before you count prepaid taxes and insurance. That's actually a little lower than the national average, according to mortgage lender JVM Lending. Add the prepaids in, though, and the realistic range climbs to 2 to 5%. On a $905,000 house, that's $9,050 to $45,250, due before you've spent a single night in the place. The county adds its own small cut on top, a documentary transfer tax of $1.10 per $1,000 of the sale price. Sellers carry their own 2 to 3% on top of that, before any agent commission. Buy above $5.4 million in the city of Los Angeles specifically, and you owe another 4 to 5.5%. Under a 2023 measure the city calls the mansion tax. Irrelevant to the house in this example, but a useful marker of how far the state will tax a transaction once the price gets big enough. Here is the part that surprises people. California is assumed to be a brutal property tax state because the prices are brutal. It isn't. The state's effective property tax rate, what you actually pay each year as a share of your home's value, not the number printed in the state constitution, sits around 0.71 to 0.76%, according to the Tax Foundation. That ranks California about 33rd out of 50 states, below the roughly 1.1% national average. The reason traces back to a single ballot measure. In 1978, California voters passed Proposition 13, which the State Board of Equalization still administers today. It set the base property tax rate at 1% of a home's assessed value, plus whatever a local voter-approved bond adds on top. The assessed value locks in at your purchase price. It can only rise by inflation or 2% a year, whichever is lower. It only resets to full market value when the house changes hands or gets rebuilt. On the median California home, that structure works out to roughly $10,600 a year, or $883 to $1,004 a month. It is the one line in this entire budget you can actually predict a decade out. Newer developments sometimes carry an extra layer on top. A Mello-Roos district, a special local tax voted in to pay for a new subdivision's roads, schools, and sewer lines, typically adding another 1 to 1.5% of home value a year. It's real, and worth asking about before you buy in a new development, but there's no reliable statewide count of how much it adds up to. Even the state's own Bond Oversight Commission doesn't total it in one place. The 1% line is the one you can bank on. This one isn't the story tonight. Add up the rest of the stack first. Utility bills alone run about $509 a month for the average California household, driven mostly by electricity. The state's residential rate sits at 35.25 cents per kilowatt hour versus an 18.83 cent national average, the second highest rate in the country after Hawaii. Maintenance, using the standard 1 to 2% of home value rule, adds $754 to $1,508 a month more. None of that is the volatile line. The volatility moved. It moved into insurance. In May of 2023, State Farm, California's largest home insurer, announced it would stop writing new homeowners policies in the state entirely. It cited construction costs, wildfire exposure, and the price of its own reinsurance, according to a consumer alert issued by the California Department of Insurance. 11 months later, it went further. 72,000 existing California policies were non-renewed by that summer, 30,000 of them homeowners, the rest commercial apartment buildings. Allstate paused new homeowners, condo and commercial policies across the state around the same period, citing the same reason. Insurify's projections, cited by Newsweek, put the average California homeowner's premium at $2,424 in 2024. That's up 10% from the year before. The same projection forecast a 21% jump in 2025 to $2,930. That's the statewide blended average, the number that includes inland counties nobody worries about burning. If your house sits in a mapped wildfire zone, the real quote looks nothing like that average. $417 to $1,000 or more a month, $5,000 to $12,000 a year. Insurance shopping sites tracking the highest risk zip codes have logged individual quotes north of $25,000. When a private insurer won't write you a policy, California has a backstop. The FAIR Plan, a state-created insurer of last resort that anyone can be placed on when the standard market turns them down. It is not a bargain. The state's own Department of Insurance put FAIR Plan enrollment at 573,739 policies as of March last year, up 23% in 6 months, up 74% in 18 months, up 139% since September of 2021. Its average homeowner premium runs close to $3,000 a year, roughly double what a standard policy costs, according to reporting by CalMatters and Stateline. In 2022, the FAIR Plan covered 1.6% of California's residential insurance market. By 2023, it was 3.7%. The line has kept climbing since. This isn't limited to one company or one bad headline year. Analysis of state data found private insurers have pulled back or stopped writing new policies entirely in 46 of California's 58 counties. Standard market policies in the highest-risk wildfire areas fell 19% between 2015 and 2023, and the state's own Department of Insurance estimates that 20 to 25% of non-renewals statewide are insurer-initiated, not homeowners quietly switching companies on their own. The retreat is broad. It isn't a handful of anecdotes. Here's what that actually looks like happening to a specific street. In July of 2024, State Farm dropped roughly 1,600 home policies in Pacific Palisades, the Los Angeles neighborhood, plus another 2,000 across the adjacent communities of Brentwood, Calabasas, Hidden Hills, and Monte Nido. That's according to the California Department of Insurance, as reported by CBS News. FAIR Plan enrollment in Pacific Palisades had already quadrupled since 2020. By 2024, roughly 1,400 of the neighborhood's 9,000 homes were covered by the state's insurer of last resort, instead of a standard policy. 6 months later, on January 7, 2025, the Palisades fire burned through much of that neighborhood. The FAIR Plan is now carrying an estimated $4 to $6 billion or more in exposure from that fire and 2 others that burned the same week. The largest loss in the plan's history, according to figures presented to the state legislature's insurance committee. This is the part that should sit with you if you're buying here. The insurer didn't leave after the fire. It left first. The non-renewal notice arrives on ordinary paper, months before anything happens. By the time you find out whether it mattered, you're already on the more expensive plan, in the neighborhood everyone else just stopped wanting to insure. It has happened before, in the same state, under the same mechanism. After the Camp Fire destroyed roughly 90% of Paradise, California, in November of 2018, insurers didn't just decline to renew burned lots. One insurer, American Reliable, declined to renew coverage for Paradise residents whose homes had survived the fire intact. Years later, one surviving homeowner's premium quote had jumped from $1,191 to $9,754, a roughly 720% increase, according to reporting compiled by CBS San Francisco and the Rebuild Paradise Foundation. Pacific Palisades wasn't the first time this played out. It was just the most recent. It gets worse, and it doesn't stay contained to the fire zone. After the January 2025 fires, California's insurance commissioner, Ricardo Lara, authorized the FAIR Plan to assess its member insurers $1 billion to cover the shortfall. That's Order Number 2025-1, a companion bulletin, 2025-4. Then let those same insurers recoup up to half of what they paid into that assessment by adding a surcharge to their own policyholders statewide. Not just policyholders in the burn scar, every policyholder. CalMatters put the estimated add-on at roughly $60 per policy. A consumer group called Consumer Watchdog sued to block it. They argued the surcharge shifts a cost the law intended insurers to absorb onto homeowners who never filed a claim. The case went to trial on June 30th of this year. The court sided with the commissioner and let the surcharge stand. Consumer Watchdog said it was weighing an appeal. So if you buy inland, Fresno, Sacramento, nowhere near a tree line, you are still, by design and now by court ruling, one of the people paying down someone else's fire. There's a downstream number worth watching too. ATTOM's mid-year report counted 227,548 U.S. properties with a foreclosure filing in the first half of this year, up 21% from a year earlier. California's own foreclosure rate sits at roughly 1 in every 3,514 homes, the 12th highest in the country. ATTOM's own analysts have tied part of that rise directly to rising insurance and property tax costs, squeezing homeowners who otherwise carry a fixed mortgage payment. The tax bill was never going to be what pushed anyone out. The insurance bill might. Run the actual math both ways. Best case, you buy the median $905,000 house somewhere without meaningful wildfire exposure. Mortgage, $4,614. Tax roughly $940. Insurance around $118 a month. Utilities and maintenance as established above. Call it $6,900 a month, all in. Worst case, same house, same price, wildfire zone address. Swap that $118 to $1,000 or more. You're at $7,200 to $7,900 a month before anything actually burns. If it does, and you end up on the FAIR Plan, you're paying close to double the standard premium for less coverage, capped at $3 million on the residential side, while also carrying the statewide surcharge that pays into everyone else's version of the same story. There's a genuine argument that none of this matters if the house appreciates enough to cover it. California's median has moved from $478,700 in 2015 to $904,640 now, close to doubling in about a decade. That's real. Nationally, Zillow's research puts the rent versus buy break-even at about 6 years, down from an 8.4-year peak in 2023. But Zillow's own research division has found that in San Francisco and San Jose specifically, renting stays cheaper than buying over a full 30-year horizon. The math never crosses over at all. I'll admit that's the one number here I'd want to double-check against local rent data before repeating with total confidence. It's still the honest finding. The tax office was never the threat. Proposition 13 did exactly what it was built to do. It made your property tax bill the one line in this budget you can actually plan around for 30 years. The instability moved next door. Into an insurance market the state is now actively restructuring in real time, spreading wildfire losses from the zip codes that burn onto the ones that don't. You bought the house. You didn't choose whose fire you're insuring.